What if everything you know about investing is designed to keep you from getting truly rich? What if the assets most people pour their money into are nothing more than wealth illusions, clever traps that give the appearance of growth while silently bleeding you dry? Welcome to STANOK Finance. Today, we're exposing the tiers of wealth-building assets, from those that destroy capital to those that create generational fortunes. This isn't about what's popular, this is about what actually works. Before we begin, comment below, what's one investment you regret making? F tier, the wealth drains. These aren't investments, they're financial traps disguised as opportunities. Lotteries and gambling. Americans spend over $100 billion annually on lotteries. The odds of winning a major jackpot? Roughly 1 in 300 million. You're more likely to be struck by lightning. This isn't investing, it's statistically funded hope. Luxury liabilities, cars, watches, designer goods. These aren't assets. They're liabilities masquerading as status. A new luxury car can lose half its value in 5 years. As Warren Buffett famously warned, if you buy things you don't need, you will soon sell things you do need. Speculative collectibles. From Beanie Babies to NFTs, these markets prey on the uninformed. Without deep expertise, you're not investing, you're gambling. Even if you own something valuable, illiquidity means your money is trapped. The bottom line, F-tier investments consume capital. They don't generate cash flow. They don't appreciate. They exist to make you feel rich while making someone else actually rich. D-tier, the fragile assets. These might not destroy wealth, but they won't build it either. Commodities, gold, silver, yes, they preserve wealth, but they don't grow it. Gold's 50-year return barely outpaces inflation. It generates no cash flow. It just sits there. A safe haven? Perhaps. A wealth builder? Number. Single rental properties. The dream of passive income often becomes a nightmare of repairs, tenant issues, and negative cash flow. Without scale, you're not a real estate investor. You're a hobbyist landlord. Why they fail? D-tier assets are fragile. They depend on perfect conditions. No vacancies, no market crashes, no surprises. Real wealth isn't built on luck. C-tier, the safe mediocrity. These won't ruin you, but they'll bore you to death while underperforming. Bonds, U.S. Treasuries return 4 to 5% annually. They're safety plays, not growth engines. Your money is parked, not working. REITs, sensitive to interest rates and often underperform equities. In 2022, REITs fell over 25%. You get volatility without the upside. Expert collectibles, even legitimate art or vintage cars suffer from illiquidity. You might own $1 million painting, but if you can't sell it, you're illiquid, not rich.
The verdict: C-tier assets are for preservation, not acceleration. They're the financial equivalent of a comfort zone. B-tier, the foundation of real wealth. Here's where wealth building actually begins. Index funds, S&P 500. The simplest path to millionaire status. $10,000 invested in 1980 would be worth over $900,000 today. It's diversified, liquid, and hands-off. Dividend aristocrats. Companies like Coca-Cola and Johnson & Johnson have raised dividends for decades. You get paid to hold them. The downside? Lower growth than tech disruptors. Scaled real estate portfolios, 5 to 10 properties, spread risk and generate real cash flow. This isn't a side hustle. It's a business. Why they win? B-tier assets are repeatable, scalable, and accessible. You don't need luck, you need consistency. Have you started investing in index funds? Reply yes or no below. A tier, the wealth accelerators. This is where the elite play. Private equity and venture capital top-tier PE firms return 12 to 15% annually. The catch? High minimums, $250,000 plus, locked-up capital and exclusivity. Franchises, McDonald's, Chick-fil-A. Proven systems, built-in demand. Profitability is high, but buy-in costs range from $500,000 to $1 million. Commercial real estate, apartments, offices, retail centers. Returns average 9% annually, but you need significant capital to play. The reality, A-tier assets require capital, connections, or expertise. Without them, you're on the sidelines. S-tier, the generational wealth machines. This isn't investing, it's ownership. Owning a business. 70% of millionaires are entrepreneurs. A business pays you twice, through cash flow and eventual sale. A $500,000 per year business can sell for $2 to $5 million. No stock can match that leverage. Early stage equity startups. $10,000 in Amazon's IPO would be worth $1.6 million today. The risk is high, but the rewards are historic. Top creators earn millions yearly. You're not selling time, you're scaling influence. S-tier assets aren't bought, they're built. They operate on leverage, scalability, and ownership. Wealth isn't about picking assets. It's about understanding tiers. F and D tier. Wealth destroyers. Avoid them. C tier. Wealth preservers. Use them sparingly. B tier. Wealth builders. Start here. A and S tier. Wealth multipliers. Require capital or creativity. Your goal isn't to collect assets. It's to climb tiers. If you're ready to escape mediocre investments, subscribe to STANOK Finance. We expose the strategies that build real wealth, not the illusions that break it. Like and share this with someone who needs to see this. This is STANOK Finance. Truth, money, power, redefined.